Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to Merryn Talks Money, Markets Wrap, where we talk about the biggest moves in the markets this week and what is driving them. I'm Merryn Somerset Webb, Editor-at-Large for Bloomberg UK Wealth.
And I'm John Stepek, Senior Reporter at Bloomberg and author of the multi-award-winning Money Distilled newsletter.
And the audience rolls their eyes as one.
That's what I like to hear.
Now, John, listen, we're supposed to be talking about the biggest moves in the markets, and this week there really is one. I know you watch silver very closely. You love silver. And it's $60. $60. What's happening?
Well, it was funny because earlier today I was looking at it and I was like, oh my goodness, silver's above $60 an ounce. And I was also thinking, it was actually me and my wife's 25th wedding anniversary this year.
Oh, is that silver?
It was silver, aye. And the thing is, I bought her something silver for the anniversary, and it was back in the first half of the year.
Oh, nice.
And I've realised that silver has basically doubled since I bought that anniversary present, so now I'm wondering how I can ask her if we can pawn it.
She's probably done it already, John.
That's probably true, yeah. I was like, oh, your hair's looking nice. That'll be why. There we go.
Trust me, if you bought her something nice, you got a lot more for it than a new hairdo.
Maybe not. But yeah, so it's been quite the surge for silver, and obviously gold's had a great year as well. But yeah, silver's just the one that keeps blowing my mind slightly because it's never been above $50 an ounce for a sustained period of time, and now it seems to be.
Yeah. Although to be fair, gold's never been above $4,000 for a sustained period of time, so we're all in the zone here.
Well, this is true, but silver's got that thing where it actually did hit 50 or nearly hit 50 in as far back as 1980, and you always think, oh, okay, now we're going to come to the point where it all collapses, but it seems we're in a new paradigm. And basically I think that's because we are back to an inflationary environment, and it keeps gradually dribbling into the market's consciousness that this isn't just going to go away. This is the new normal for the foreseeable future, really. The backdrop is more of an inflation risk than a deflation risk.
Okay. There's controversy over that, isn't there? I mean, there's some people out there who think we're moving into a new deflationary environment, but you and I, we're natural inflationists, aren't we? Because we can't see any way out of the global debt problem.
I think there are individual things that could happen to trigger bouts of deflation. And obviously a recession is sort of deflationary. But I think the way where we are dictates that politics is going to be inflationary, and I think that is fundamentally why I would expect more inflation going forward rather than less. And I do think that one issue or one problem at the moment is that governments are simultaneously, so governments are very indebted. They're aware at some level that the best way to get rid of the debt is to have nominal GDP growth, which is high, so that you know, even if real GDP growth is low, it doesn't matter. The main thing is that you're growing fast enough to pay back the debt faster than it's building up.
Yeah, although just to be clear, real GDP matters to real people.
Oh, it matters to real people. Yeah, we're talking about just
not to government.
Yeah, how the government can soft default on its debt, basically. Yeah. So encouraging a higher level inflation is a good thing for them, from their point of view. At the same time, they know the cost of living annoys voters. And I think the trade-off there is, and we're already starting to see it, is going to be something, basically price controls, not overt price controls necessarily, but more and more things slipping in, like for example, Rachel Reeves freezing the train tickets in the budget and various other kind of minor moves that are short-term moves to make inflation look lower than it is for the next year, say. Like the Bank of England thinks it'll cut about 0.5 percentage point off headline inflation, but that's only for next year.
But it's interesting, isn't it? Because one thing we do know about price controls is that they don't work.
Yeah, they don't work in the longer run.
They don't work. You can't make prices stay down. And there was that very interesting article by old friend of the podcast, Simon French, a little while ago. I don't know if you read it, where he explained that the problem with the UK is that one of the many problems with the UK is that effectively runs a system of price controls across the economy. Everything is controlled one way or another.
Yeah, and it's extremely striking now. I think, it's been going on for a while, but like so many things are indexed, and I think in the wages market particularly, the kind of just relentless rise in the minimum wage specifically, and you do also have the benefits system kind of playing a big part in this, but a less clear one. But we've almost kind of simultaneously put a floor under wages, but it's so high that it's putting a cap on wages at the other end of the spectrum. So really the relationship between reward and effort is being very disrupted, and that's extremely bad for productivity because people's incentives are not designed properly.
Yeah, so effectively our wage and price controls bake inflation in rather than the other way around.
Yeah, which is really bad. I said there's so many things that need to be unwound and dismantled if we want to get the UK back into a good place. But I don't see that happening anytime soon.
And you wrote this week, John, you were writing about central banks and interest rates and political pressure to keep rates down. And obviously we feel that in the US and are seeing that in the US. And there's a lot of political pressure in the UK as well to keep rates low, even though we feel there is this inflationary backdrop.
Yeah, I mean, it was interesting because Rachel Reeves was in front of the Treasury Select Committee either yesterday or the day before. The whole point was about the budget and the run-up to the budget. But one of the Conservative MPs in the Select Committee asked her a question that she wasn't particularly keen on, and then she kind of laughingly pointed to the fact that they'd managed to have 5 interest rate cuts under the Labour government, as if that was an achievement of the government. And it's this thing where you've got the government realising that it wants interest rates to go down, and having pinned its kind of reputation on creating an environment in which the Bank of England can cut rates. And even if it's doing nothing else, there's an element of pressure there on the management of the central bank to meet the government's expectations, regardless of which government it is. It's all part of the state apparatus ultimately, and independence is really just it's just a fig leaf.
It's a mirage, isn't it?
Yeah, exactly. So you're always, whenever you've got even good politicians talking about it like that, I mean, obviously Trump is very overt about it. It's like, I think the Fed cut interest rates by a 1/4 point yesterday, and he just puts out a tweet immediately, or the equivalent of a tweet, saying that this is a waste of time, Powell's useless, and I can't wait till we get somebody proper running this thing. And so that's very overt, but the same sort of pressure is there from kind of across the board.
And you also mentioned in the same piece you wrote about that, you talked about energy and oil prices. We both read the same article, didn't we?
Yeah.
The GavCal Daily on what are today's contrarian trades. And one of the contrarian trades that you could take at the moment is oil, in that it's been sort of remarkable how cheap oil has stayed all the way through this year.
Oil started the year around about 80 and it's down to almost 60 now. I think you got to think about how much that's also played into the fairly calm inflationary environment this year. Because one thing you can usually say for sure is that oil going up is inflationary. In the longer run, it's deflationary because it acts as a tax, but in terms of your headline prices, they're going to go up with the oil prices going up because that feeds through to everything else. So I think that yes, I think one of the surprises for next year might be oil coming back more sharply than anyone expects in the moment, because everyone's talking about how there's a supply glut. And also, I was looking at that piece and I thought it was an interesting piece, but of the 4 contrarian trades he suggested, I definitely thought the energy was the most kind of compelling one, because you can see how it could happen more readily than the other ones he suggested.
We need to get somebody on to talk at length about the possibility of a new commodity super cycle. We're going to do that in the new year. We'll talk about the commodity spectrum as a whole. We haven't done that for ages, so stand by. We'll be doing that in January or February. But the last thing I wanted to talk about today was Howard Marks, who we have had on the podcast before, and he writes these great letters, and another one out this week, and this is about the AI bubble, or not. Is there a bubble? Isn't there a bubble? Did you read the note? I read it briefly. Well, actually, no, I did read it. I read everything Howard Marks writes.
Yeah, I did read it. Yeah, I thought it was good. It was very sensible, which is always slightly galling because you want something, really punchy
drama.
that you can write about. Yeah, but I don't know. I think if Marx is kind of coming out and saying, because he does know his bubbles, at the .com bubble and at the the financial crisis bubble, he wasn't backwards at coming forward. He wasn't particularly equivocal. You could read it and say the stuff he wrote then and say, no, he's saying this is a bubble and it's probably going to burst quite soon. Whereas with this one, he's very much more equivocal. And that's one reason I kind of thought, well, AI is a weird one because simultaneously it doesn't feel as if we've got quite enough frenzy. Everyone's a bit too sceptical still about it.
Not in California. I mean,
I suppose not in California.
And we hear a lot of skeptical stuff, but people who are in the bubble are really in the bubble.
Yeah. I think
hugely optimistic, incredibly excited, vaguely worried about existential threats from the end of the world and the possible sentience of AI and that kind of thing. But generally, very, very excited.
Oh yeah, I mean they are, and that's true.
And maybe Howard's been having lunch in California. One of the things he says that is worth mentioning is that he says, in every bubble people say this time it's different, and then the rest of us say it's never different. But a small percentage of the time, it is different. Maybe 20% of the time, it really is different. And you can look at AI and say, do you know what? This kind of is different. The products exist. People buy them. Revenues are going up. Maybe not quite enough. But, it exists. It can make money. There's a path to profitability. It's real.
Yeah, I mean, I think that's all true. I'm not sure that even means it's different this time, though. I mean, the internet was different and it did make money, but it was still a bubble. I think it's maybe trickier at this point to turn around and look at the bits of it that are definitively bubbles, because, I mean, obviously NVIDIA is the kind of the picks and shovels stock. And everyone's actually, it's only gone up 20% this year, having gone up about 200% last year. But you don't have the same sort of stocks that were around in the .com boom, or at least they don't have the profile. There's not a lot of companies kind of suddenly coming out with flaky sounding AI products that are then going to the moon. But then again, a lot of that's maybe in the private credit area where we are not looking so much.
We're not looking.
So actually, yeah.
Well, I suppose the thing that he does say, that the thing that worries me, and we've talked about before, is that until very recently, all of the investment in AI it came from cash.
Yeah.
It was equity cash flow, but not anymore. Now there's a lot of debt in here, and that changes the whole dynamic, I think, back to private credit. There's a lot of debt knocking around in the big AI companies now. And we've seen that compression of credit spreads as well, which suggests that people are very much aware of the level of debt that the big AI companies are coming on now. I mean, as Mark says, debt doesn't have to be a problem. It's not a good thing or a bad thing in itself. It just comes down to how much debt you have, the quality of the assets, the cash flows you're lending again, all that kind of thing. But nonetheless, it's a shift from, look, we got a pile of cash. We made a pile of cash because we're a great tech company, so we're going to spend it on this new thing, to this new thing is so competitive and requires so much money that we no longer have enough cash, and we're going to go and borrow a big pile of money. It's a big change. Yeah. And it's relatively recent.
And it is also very opaque.
Yeah.
And I am noticing more articles, even on the Bloomberg site actually, and generally just talking about the role of the banks in funding things that sound very much like the sorts of products that ended up getting them into trouble in 2008. So, lots of off-balance sheet stuff that looks as if the risk is all on one group of people, but fundamentally, if it does blow up, you're the one that's going to own it. And I don't know how long it takes before, significant risk transfers or SRTs are kind of, featuring the equivalent of a kind of whoever Robert Peston is these days, sort of like report on the BBC. But it does feel as if we are nudging towards something like that. Whether it'll ever get to that point is a slightly separate issue. But I do, I think there is a problem with visibility in this particular bubble that you certainly didn't have in the .com bubble, because all of that funding was done through IPOs.
Yeah, that was much more transparent.
What about his bit on jobs? Did you read the PS? Because I almost felt as if...
No, I didn't read that bit. What did it say?
Well, no, I almost felt as if... Because actually, one thing I found a little bit disappointing about the memo is that obviously he's a credit guy, and I was kind of hoping he would say more about the credit side beyond, okay, well, that's not always a bad thing. And that it's all getting a bit speculative, but I don't know, where we are in the cycle. But the thing he was talking about, and actually, to be fair, this probably does lean into perhaps he's seeing it as being too different, was kind of stressing about basically the number of job losses that it's going to cause. It's going to kind of wipe out whole tiers of industry, and then what will happen. And he was sort of making, it's an argument you've heard before from other people, but the idea is that we'll live in a kind of almost tech feudalism where you've got Silicon Valley millionaires and then everyone else is on universal basic income or something like that.
Yeah, well, I do accept that this is the kind of thing that happens slowly and then incredibly fast. So, we're in the foothills of the whole, how many jobs can AI do? Will it take your job? How many jobs will it take? And everyone's going, oh, well, it hasn't really happened yet. Bit of an increase in the productivity of customer services representatives, bit of this, bit of that. But it's not a flood yet. But there will come a point when it's much quicker.
Yeah.
And it's maybe not that far off. But we're not going to talk about that because it's nearly Christmas.
Yeah, let's not put a downer on the readers before Christmas. We don't normally do that.
Definitely not. No, we don't do that.
I keep calling you readers. Sorry, you're listeners.
Yeah, listeners. So, John, end us on something positive. You wrote earlier this week about how everything was just fine in the gilts market.
Actually, yeah. Let's wait till the local elections, but between now and then, there's probably not going to be many kind of fireworks in the gilt market. And actually, this year, there actually weren't. It felt like there were, but the gilts are kind of like 10 years are ending roughly, in fact, a little bit below. Your 10-year yield is roughly a bit below where it started the year at. So overall, for all that it's been a kind of fairly grim and chaotic year politically, all the hype about the gilts market has come to nothing. And I think given that the UK still has one of the highest base rates, in fact it is the highest base rate in the developed world at this point, there's still room for the Bank of England to come down. And if it turns out that the economy is even worse than expected next year, then maybe the Bank of England comes down a little bit more than everyone's expecting. So that would probably mean that kind of gilt yields go down a bit and therefore gilts perform okay next year.
Excellent. So here we are, straight into the dynamic that you and I have worked with for so many years. Bad news is good news.
Excellent. That's a
The economy suffers and your gilts do fine. So let's end on that cheery note, shall we?
Yeah, I'd say Merry Christmas, but there's at least one more of these, isn't there, before we wrap up for the year?
No one's getting off that lightly. It's only the 11th. Thanks for listening to this week's Merryn Talks Money Markets Debrief. If you like our show, rate, review, and subscribe wherever you listen to podcasts. Also, be sure to follow me and John on X or Twitter. I'm at Merryn SW, and John is John_Stepek. This episode was produced by Summer Sadi and Moses Andam.